Dive into a wild ride through skyrocketing inflation, the Fed's potential rate cuts, and how markets are defying all odds. With experts unpacking crucial trends and offering game-changing insights, this is a must-watch for anyone looking to stay ahead in these turbulent times. Don't miss out. Your financial future may depend on it. Today, on Financial Experts in Review, we will summarize the following videos. From Danielle DiMartino Booth, we have Report renews focus on double-digit inflation for key items past 5 years. Cavuto, your world. From Danielle DiMartino Booth, we have the Fed can cut rates in September, and it will not be political. DiMartino Booth with Blake Morrow. From Trade Brigade, we have Will Micron earnings crash Semiconductors? From Figuring Out Money, we have the Great Stall of 2024. From Mott Capital's Market Chronicles, we have Stocks Continue to Defy All the Odds. From Eurodollar University, we have You Won't Believe What China's Central Bank is Doing. In this engaging episode from Danielle DiMartino Booth's YouTube channel, former Dallas Fed advisor and current CEO of Quill Intelligence, Danielle DiMartino Booth dives deep into the pressing issue of inflation. With a keen eye on economic policy, Danielle explores the alarming double-digit inflation on key items that Americans have faced over the past 5 years, just in time for tomorrow's CNN presidential debate. She brings her insider perspective and extensive experience in economic analysis to the table. The core thesis of the discussion is the substantial double-digit inflation affecting crucial items like food and housing over the past 5 years. Booth argues that despite claims of inflation cooling down, prices have merely stabilized at elevated levels rather than decreasing. She emphatically states that to bring relief to Americans, producers and businesses must take active steps to lower prices by increasing competition and leveraging more cost-effective practices. Here are the key points discussed by Danielle DiMartino Booth. Current state of inflation. Danielle highlights that prices haven't come down significantly, but the growth rate of price increases has slowed. Evidence. She references comments from the CEO of Walmart about Americans shifting towards private label brands and using digital coupons to economize. Cost factors influencing prices. Booth discusses the multifaceted reasons behind the persistent high costs, including increased wages, utility costs, and transportation costs. Evidence. She provides specific increases, such as a 29% rise in electricity and a 30% increase in gas over the past 5 years. Impact on businesses. Booth points out the epidemic of job losses as companies can't sustain operations under high cost pressures, with specific examples like a trucking company closing and 2,000 jobs lost. Evidence. She mentions a trucking company outside of Houston and the broader trend of business closures across the country. Political context. Danielle touches on how President Biden might present the current job market positively, but highlights the need to look deeper into job report revisions and underlying economic realities. She counters with historical context by examining executive actions during Trump's administration that contributed to inflation. Danielle DiMartino Booth made the following predictions. Worsening economic conditions. Danielle predicts that job losses will continue to increase, exacerbating economic hardships and potentially leading to further business closures. Evidence. She cites the ongoing layoffs and business shutdowns across various sectors. Danielle DiMartino Booth concludes by emphasizing that the solution to the current inflation crisis involves producers and businesses taking competitive actions to lower prices. She calls for heightened awareness of the true state of the job market and the necessity for policy adjustments that can bring substantial economic relief to Americans. Her call to action involves urging both consumers and policymakers to acknowledge and address the deeper issues at play in the economy. Welcome back to Danielle DiMartino Booth's channel. In today's insightful video, Blake Morrow from Trader Summit engages in a dynamic conversation with Danielle DiMartino Booth, CEO and Chief Strategist at Chi Research, formerly known as Quill Intelligence. As the celebrated firm celebrates its 9-year anniversary, they delve into the Federal Reserve's potential rate cuts, the macroeconomic environment, and the state of consumer confidence amidst rising inflation. The core premise of the video centers around the Federal Reserve's capacity to cut rates in September and the notion that such a move would not be politically motivated. DiMartino Booth emphasizes how economic indicators, such as housing price data, consumer confidence, and unemployment trends, substantiate the possibility of a rate cut, despite a politically charged environment as the election approaches. Here are the key points discussed by Danielle DiMartino Booth. Economic data overview. Home price data often reflects the state of the market from 3 months prior, and current data shows increasing inventory, reminiscent of pre-2019 levels. Consumer confidence in the broad economy is crashing, yet many individuals still feel secure about their own financial situations. Unemployment rates are up to 4%, with layoff announcements becoming common in months that don't typically experience such trends. Federal Reserve's potential actions. The current chairman, Jerome Powell, is likely to cut rates in September if economic data weakens further, irrespective of the impending election. Powell has historically shown he is not politically driven and is committed to acting based on economic conditions. Stock market sentiment. Stock markets often ignore macroeconomic warnings until the Fed makes a rate cut. Market overvaluation and high degrees of indebtedness are reminiscent of 2000 and 2007, still flying under the radar for many traders. Danielle DiMartino Booth made the following predictions. Rate cut in September. DiMartino Booth predicts the first rate cut could occur in September, should the job market show signs of significant weakening by the July and August employment reports. Such a rate cut would be based on material economic deterioration rather than political motivations. Continued economic decay. She foresees ongoing layoffs and rising unemployment, suggesting further economic challenges ahead. Danielle DiMartino Booth concludes by advising caution in the current economic landscape. She suggests diversifying portfolios, particularly for those nearing retirement, and underscores the importance of staying informed about the underlying economic trends and Federal Reserve actions. The looming potential for rate cuts amidst a politically charged environment calls for strategic adjustments in individual financial planning. Welcome to Trade Brigade, the one-stop channel for all your market updates and trading insights. The central argument presented is that despite the initial panic caused by Micron's earnings announcement, the semiconductor market and broader indices remain resilient. Mott analyzes various charts and market data to conclude that the current uptrend is intact and the market is well positioned to absorb any immediate shocks stemming from Micron's earnings miss. Here are the key points discussed by Mott's SPY daily and hourly timeframe. The SPY daily timeframe reveals an uptrend with soft higher lows, indicating a resilient market. On the hourly chart, the failure of momentum sellers to push prices lower suggests bullish consolidation. Economic indicators, upcoming jobless claims, and GDP data may influence market direction, but as of now, there's no strong evidence for a downturn. Market internals exchange-level data shows no substantial volume outflows. Advanced decline lines suggest mild negativity, but not enough to confirm a strong bearish trend. Sector analysis, energy, communications, and discretionary sectors are leading, while technology and semiconductors show high, constructive consolidations. Consumer staples, utilities, and financials remain neutral or slightly defensive, but not overwhelmingly bearish. Mott made the following predictions. Market resilience. Despite the negative news from Micron, Mott expects the market to remain resilient with possible bullishness in the near term. Stronger sellers should appear under certain low points, but current data points to continued buyer interest. Sector rotation. Sector rotation will continue with strength in communications, discretionary, and technology, possibly even navigating minor pullbacks. Semiconductors may face temporary headwinds, but long-term trends remain robust. Mott concludes that the broader market remains in a solid uptrend, despite the hiccup caused by Micron's earnings. He advises traders to focus on higher lows and bullish setups while keeping an eye on crucial support and resistance levels. As always, he stresses the importance of staying updated with economic indicators and sector performance to guide informed trading decisions. On this episode of Figuring Out Money, we dive into what's being dubbed the Great Stall of 2024. We're dissecting the looming seasonal stall-out in the S&P 500 and the Nasdaq Composite, despite recent breakout performances from mega-cap stocks. Highlighting the insights is our host, a seasoned financial analyst whose technical analysis expertise brings depth to these complex market movements. The core thesis of the video centers around a potential market lull or correction as the S&P 500 and Nasdaq Composite head into a traditionally weak seasonal period, despite strong breakout moves from mega-cap stocks like Amazon, Tesla, and Microsoft. This paradox between strong corporate performances and potential market slowdowns sets the stage for deeper market dynamics analysis. Here are the key points discussed by seasoned financial analyst S&P 500 and Nasdaq Composite analysis. Amazon and Tesla led significant moves in their sectors, with Tesla reclaiming its year-to-date anchored volume weighted average price. Other major stocks like Microsoft, Google, and Apple are also hitting new highs, making a stall-out seem improbable, yet possible. Intermarket dynamics. 10-year yield and the dollar are rising together, historically leading to market declines. Correlations between Treasury yields and the S&P 500 are currently mixed, suggesting a nuanced market response. Historical and seasonal trends. Seasonal patterns suggest a potential stall-out or correction based on past presidential cycles and aggregate market cycles. Market breadth metrics indicate fewer stocks are participating in the rally, which may signal weakening internal market strength. Upcoming events, durable goods report, GDP data, and the presidential debate are key upcoming events that could inject volatility into the market. Seasoned financial analyst made the following predictions. Potential market correction. As seasonal and historical data suggest, a market correction or stall-out is possible in the near term. The host highlights the importance of paying attention to technical indicators and volume-weighted average prices as signals. Volatility in response to upcoming data. The release of durable goods and GDP data could add volatility, particularly in the context of current gamma levels at key resistance points. The video concludes by emphasizing caution as the market approaches historically weak seasonal periods amidst strong corporate breakouts. Key gamma levels at 5450 and 5500 will be pivotal, suggesting traders should watch these levels closely for market direction. Calls to action include being tactical with positions, considering both the potential for a market stall and significant economic data releases on the horizon. Welcome to Mott Capital's Market Chronicles. In today's episode, we delve deep into the perplexing realm of stock trends that seem to defy all odds. The core thesis of the video revolves around the current market anomaly, where the S&P 500 is holding strong, while other indices and indicators show signs of declining liquidity. Cramer seeks to unravel why the S&P 500 is defying market norms and what this divergence means for investors. Here are the key points discussed by Maxbar. The host is none other than Michael Cramer, founder and portfolio manager at Mott Capital Management, who brings years of experience in market analysis and portfolio strategy to our discussion today. Liquidity. Leaving the market. Cramer explains that reserves are coming down, indicating a reduction in liquidity. Equity indices like the Russell 2000 and Bitcoin are showing price actions consistent with reduced liquidity. S&P 500 divergence. The S&P 500 has not complied with the broader market's decline. Cramer links this anomaly to the influence of NVIDIA and ongoing AI trade. Gamma levels and market stability. Gamma levels have significantly fallen, posing potential market volatility if certain levels, like the zero gamma level, around 45 forward 450, are breached. S&P 500 futures and Nasdaq futures are trending lower after Micron's earnings report. Broader economic indicators. Homebuilder data is inconclusive but showing signs of potential strain. Copper and oil prices indicate inflationary pressures despite recent declines. Global economic context. The US dollar and global currencies like the euro and British pound are showing potential volatility due to political events and economic indicators. Australian bonds reacted strongly to hot inflation data, signaling persistent global inflation risks. The host is none other than Michael Cramer, founder and portfolio manager at Mott Capital Management, who brings years of experience in market analysis and portfolio strategy to our discussion today. Made the following predictions. Increased market volatility. Cramer warns that if the zero gamma level is breached, it could result in intensified market volatility and potential declines in the S&P 500. continued inflationary pressures. Persistent inflation signs in commodities like copper and global economic data suggest that inflation is far from over. Michael Kramer concludes with a cautionary note. The apparent strength of the S&P 500 may be masking underlying liquidity issues and potential market volatility. He urges investors to stay vigilant, keep a close eye on key support levels, and consider the broader economic indicators and their implications for future market stability. Welcome back to Eurodollar University. Today, we delve into a groundbreaking topic, the People's Bank of China and its planned transformation. Our guest today is Jeff Snyder, the head of global research at Alhambra Investments, a recognized expert in the shadow money system and central banking. The core thesis of this video is an exploration of the People's Bank of China's PBOC radical shift in monetary policy. Despite speculation, this isn't about unleashing quantitative easing, QE. Instead, the PBOC aims to adopt a communication-centric approach, similar to Western central banks like the Federal Reserve and the European Central Bank. This move reflects underlying issues in China's monetary system, particularly the ineffectiveness of traditional monetary policies in the face of a struggling banking system. Here are the key points discussed by Jeff Snyder, PBOC's transformation. The PBOC plans to buy and sell bonds to influence interest rates and improve communication. There's a growing concern over the sinking bond yields and the weakening yuan. Monetary transmission challenges. The term monetary transmission refers to the effectiveness of central bank policies in influencing the economy. Several reports, including one from BNP, highlight that China's mechanism has been impaired, particularly since the pandemic. Despite rounds of monetary easing, there is no significant recovery in credit flow and economic outcomes, signaling deep-seated issues. Historical context. China's historical context, where the influx of Eurodollars was a significant factor. Once these flows declined, the PBOC's challenges came to the fore. Comparison with Japan's multiple QE attempts, which also failed to achieve their intended effects, drawing parallels with China's current predicament. Significant quotes. Central banks, including the PBOC, are often credited with economic success only when the banking system is functioning well. Otherwise, their actual influence is minimal. Upcoming events. An upcoming webinar on June 28th at 6:30 p.m. EST will dive deeper into interest rate fundamentals and current economic trends. Jeff Snyder made the following predictions. Continued economic struggles. The ongoing inefficacy of traditional monetary policies implies that China may face continued economic challenges. Shifting to a communication-centric approach may help, but significant recovery seems unlikely without substantial structural reforms. Financial market reactions. The shift could lead to temporary volatility in Chinese financial markets as investors respond to new policy signals. Long-term impacts include potentially lowered growth expectations and continued pressure on the yuan. Jeff Snyder's analysis reveals a critical transition for the PBOC, highlighting the limitations of traditional central banking in our interconnected, globalized economy. The call to action is clear. Stay informed about these significant changes, as they will undoubtedly influence global markets. Join the upcoming webinar for a deeper dive into how interest rates function and what these shifts mean for you. Danielle DiMartino Booth discusses the impact of persistent inflation on the U.S. economy, advocating for competitive pricing to bring relief. She predicts worsening economic conditions and increased layoffs. Meanwhile, Blake Morrow emphasizes that the Fed could cut rates this September, driven by deteriorating economic data rather than political motives. From another angle, Mott from Brigade suggests market resilience despite Micron's earnings miss and anticipates sector rotation. Michael Kramer warns about potential market volatility due to liquidity issues, urging vigilance. Finally, Jeff Snyder highlights China's shift in monetary policy, predicting continued economic struggles unless significant reforms are made. Guests agree on the importance of staying informed and cautious, but they diverge on the urgency and approach needed to address these economic challenges. Thanks for watching Financial Experts in Review for June 27th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.